All right, so we'll go ahead and get started and maybe a few other people will show up here, but so I want to start with the very, very basics of deciphering flow, and some of this will be kind of individual to Blackbox as far as the coloring system, but what is not individual is the importance of open interest and why, that matters when reading options flow. So first thing I want to start with is the color of the options flow, and maybe jot down some notes. This stuff is written in the educational channel, so you can reference that, but will probably just help to hear everything explained. So on the screen, and when you see flow get posted, there are three different colors of line items, right? So you have the white, the yellow or gold, and then the magenta. So from an open interest standpoint, and why the majority of the flow you see get posted is, yellow for the day, right? Well, yellow means that this transaction exceeded open interest in one line. So to make it as simple as possible, this contract or this order was 199 contracts. That means that open interest could have been all the way up to 198 contracts, and this would have still been yellow. So it's a single line item that exceeds the entirety of the open interest. Now, why is this important? This is important because it's telling you that this has to be a brand new opening position, right? So if there's 198 contracts in open interest, just for the example, somebody can't come in and close 199, right? Because there's not that many open contracts. So the importance of the yellow lines are simply saying this is a brand new position, right? So there's a few things that we can infer from this, and I'll get into that later, but that's why when we look at like writing options and stuff, we need to see the yellow to have like a clean confirmation of it, because that tells us that it is a brand new opening position, and we can kind of dictate the read after that. So yellow is the most important. Why I started with that. That's brand new opening position. The magenta, that means that open interest has been exceeded on the day. So what you'll see on lines like that, and it will help if I can get a good example here. So you can see that this line item on Microsoft today, the first one came in white, but then they switched to magenta throughout the day. So all this means is that this contract specifically was, exceeded the current open interest in volume, right? So we can look at open interest was 1,616. So as soon as it traded the 1,617th contract today, it flipped to magenta because open interest was exceeded. So this tells you that positioning has exceeded the current open interest, and now there can be, additional tack on position building, right? Because if it's just white, which means that open interest has not been exceeded, it could be getting traded through, right? We won't know until OI confirms the next day. So it's really hard to take anything significant out of white flow. And that's why it gets posted the least, right? Because we don't know really what's happening until the next day updates on OI. And just to give you an example, right, this weekly line item is not going to be a good example, but imagine that somebody sold some calls, right? So they sold to open some calls. They want the stock to go down or stay flat for them to make a profit. And then, that happened one day earlier in the month. Well, the stock has dropped or decayed, and those contracts are now in a profit for them. So what do they do to close a sold to open position? They're going to buy those contracts back. So if you're looking at flow, it could look like ask above the ask, aggressive buying, contract prices going up. But what you don't know, unless you look through historical or wait for the next day to update on OI, is that it's not really bullish flow that you're seeing or deciding to follow. They're actually closing, a bearish position. So you'll see the OI, decrease the next day as a position gets closed. So That's why white flow can be so confusing, why you'll see us say like, confirm an OI tomorrow to see if they're actually adding, because we can't infer anything with the open interest not being traded through. Sure, it can look like buying, but we don't know for sure until we see that OI increase the next day. So with that being said, we've covered yellow, magenta, and then slightly into white there, but let's look at the type of orders that we see come through. And again, this is going to be a little bit like black box stocks oriented, because on Unusual Whales and Flow Seeker and some other services, they don't just use block and sweep designation. There's some other terms like floor trades and stuff like that. So what we'll be focusing on is just around the sweep and block orders that you see on black box. You see a sweep, you see a block, and then the ML is for multi-leg, which indicates a spread. So to start with, what do we want to see on flow? We want to see sweeps, right? So think of it this way. A sweep order is they're sweeping the exchanges to get filled on those contracts, right? So think of a market order. You just press market buy, and whatever they fill you at, they fill you at. You just want to be in the trade. That is essentially what a sweep order is. Just think about a market order where you don't care. You just want to be in the trade regardless of where you fill at. A block is, think of like you're setting a limit order and an all or nothing limit, right? So like you don't want any of the contracts unless you can get filled for the exact amount at the exact price, right? There's no urgency to your order. If you get filled, you're whatever. If you don't get filled, whatever. Typically, you'll see that a lot in hedging. You'll see like even contract count orders via blocks, usually to hedge and or cover shares, right? If someone has a certain amount of shares, you're typically going to see like an even order, right, is on like attached to shares. You more rarely see like 531 contracts, right? Because that doesn't cover an even amount of shares. So you want to see sweeps. Blocks show a bit less urgency, sometimes can be hedging and less clean orders, like we don't know the exact intent on them because they aren't as purely directional, right? They can be attached to shares or something else entirely. We'll sometimes see block orders come through with dark pool prints at the same time. So sweep is what you want to see. And now let me look real quick and find an example of like aggressive sweep buying today. So this DVN was actually really good because it shows a mix. So first thing when checking options flow, and we're still talking about orders right here, but just want to like preface this, is look at your timestamp, right? Because it tells you a bit more of a story of what's going on here. So all these orders were swept, within 20 seconds, right? So that timestamp is telling us something. Now, open interest hasn't been exceeded. These are white. So again, we don't have a clear direction yet. Like we know this is buying, but are they closing another trade? We don't know. But look at the sweeps. Contract price is going up. This is, textbook aggressive buying. Now, here's the block included into it, right? And this happens about 2 minutes after. But now we have, the clue that the initial orders were buying. And honestly, if I had to like make up in my head what happened here, the trader put in this order, this huge, order above the ask to get filled. And this was like the predecessor to this starting to get filled. Like they were able to fill $1.32 for that size. I mean, 19,000, almost 20,000 contracts in a single order. So they could have had like a, above the ask block order placed, and this is just how it transacted, like to fill their, sweep the exchanges, fill it, and then finally that last block trade got them all filled. So, I don't know that. I'm not working behind the exchanges, but just how this would read out to me. So because the block is intermixed with these sweeps, I would give it, a bit more importance than if we had seen this block by itself. Also, the fact that the block is above the ask, you rarely ever see. Blocks are typically just plain ask or bid. There's no, again, there's no urgency, right? So that's kind of why I'm like talking through this, what probably happened, because this rarely, happens on seeing these blocks like above the ask or anything like that. It's typically very, very ask or bid. There's nothing like urgent about them. So good example of flow here today, where you have a mix of sweeps and bids. Sweeps and blocks, but the block here carries a little bit more importance than it typically would if it was sitting by itself. So hopefully that paints a little bit better picture between sweep and block. But sweep, just think urgency, they want in, and you can see that as the contract prices increase here, which we'll talk about next. And then blocks are kind of limit orders here. And let me see if I can find another good example here. So on run today, these August 20 calls were hit really, really heavy. But these were all blocks, right? So not as like great a flow, still a lot of money, but kind of odd like how they came in like this on blocks. And typically I'm really surprised this wasn't sweeping flow, and then we ended up selling off from this. So just kind of interesting how that happened. Not as clean as if we had seen sweeps. And I probably could have used that DVN for the next thing we'll talk about here. But so we know what the colors mean now. We know what the sweep or block means. We'll save multi-leg for the end of it. So next piece we will talk about is actually like starting to read the flow on what we're seeing posted. And actually, since I said back to basics, let's talk about the ask and the bid first here. So all right, so this is the amount of contracts, this is the contract price, and this is where it filled, right? So B doesn't mean bought. A and B stand for ask and bid. When you see your orders on your broker, you can fill at the ask, you can fill at the bid. When you try to buy at the bid, you don't really have much luck usually, right? Unless the stock starts to come back down if you're buying calls. But typically for majority of the time, you're going to see buying on the ask and then selling on the bid. Now Black Box does have, and of course I'm not going to get any above ask or below bid orders on here. Here we go. So AA means above ask. This means they paid up and over ask to get filled. They were trying to get out as fast as possible. They were trying to get in as fast as possible. And then below the bid is going to be the same thing. They're trying to get out as fast as possible. They just want to get out of the position. They marketed order out and they got a shitty fill, below the bid or above the ask. Let me see. Let me get this question real quick. When out of sequence flow arrives, there's obviously a timestamp on it, but are we to believe the timestamp is inaccurate and irrelevant since the source data was delivered timely and in sequence, so it shouldn't be relevant to the story as it might have been from a much earlier time in the sequence? Yeah, I don't really know on the back end how the out of sequence orders come through or why they come through like that. I would say the timestamp is, irrelevant as far as speaking, I would say the most important thing on the out of sequence orders is making sure that they are actually in open interest the next day. And then seeing, sometimes the out of sequence orders will come like between the spread for some reason. So, the only time that the sequence matters is if you're like, it's in between the ask or, between the ask and bid, and you're looking for some kind of color on if you think it's buying or selling. Otherwise, it's kind of up for interpretation. but I'll try and cover that towards the end on some of that more complicated stuff. But to go back to the ask and bid, typically, we buy on the ask, we sell on the bid. There can be nuances, right? And this is where some of common sense comes into play, because you have to look at the type of name that you're looking at getting flow. How tight are the spreads? Is it like an Apple or a SPY where the bid and ask are 1 or 2 cents away, right? It makes it very tight, and it makes aggregating the data, because that's all that flow services are doing. They're aggregating or trying to show you the data the best way they can, how these are transacting against the tape on what the market is showing the ask or bid to be. So um, obviously these guys got blown out if these were actually writing, but I would stick by calling this writing anyway in the beginning of the day. But the point I want to show you here is AMAT is a wider spread name. It's not like your SPY, so you kind of have to take into consideration that fills aren't going to be like cut and dry on ask and bid, and depending on how a service is showing this data to you, there may be some discrepancies, right? So in my opinion, I think these calls were being sold. Clear contract drop here, but they're on the ask. So like this could have been really confusing if you were watching this, but we did sell off from this actually for the, into the end of the day. So this came in ask side, and this is like starting to get into like some of the nuances of flow, and people will be like, well, if it's ask side, why is it not buying? Well, again, it comes back to knowing what the name is you're watching flow on, and knowing what those spreads are. Like I know AMAT spreads are bad, but more so, and why I prefer multiple line item flows to pull from and like verify that's what they're doing, because these single lines could have been misconstrued very in a big way. Like if someone's just watching a flow service and saw this line, like they're probably like, oh my god, like AMAT's gonna go crazy today, and you would have gotten like these would have been hurt really bad outside of the MU earnings tonight, right? So it's kind of the context of having multiple lines, being able to put a story together versus just having a single line item. But just want to kind of show you, like, generally, yes, ask and bid is, ask is buy, bid is sell, but there are some nuances, and it comes from these, multiple line items that we'll start to talk about here when we try to piece together flow. So we'll just use this example to go in to start talking about piecing together a story. I've already referenced the timestamp here. So this is your most important thing that people really don't pay attention to when they first start to see flow, right? So this tells us, is this the same player, right? Or is this somebody else? So from 10:09 and 8 seconds, within 25 seconds, they filled all these orders, which, they're sweeping the market, right? They're sweeping the exchanges because they want to put this trade on immediately. There's no, and again, there's the block at the end of the sequence. Like maybe they had, a sell order for 7.7 and it got filled this way. But timestamp is your first thing to look for. This is your clue. So we know that this is the same player now, right? This is the same trader executing this trade, because, what are the chances of someone else with a few $100,000 on weeklies coming in and doing something different than what they're doing within a 20-second span, right? So we know it's the same trader based off the timestamp. And we now are going to look at our spot price. What is spot price doing while this flow is coming in? Well, it jumped up $1 here with it, between 10 seconds, jumped $1 and then kind of stagnated, but up overall within the 25 seconds from where this came in. So one thing you'll see from watching flow long enough is that when you see aggressive buying, kind of like that DVN example I showed you earlier, contract price is going to push up, due to a few factors. but mainly because it's going to push volatility up. Market makers see, a lot of rapid buying in something. They don't know why. They're going to increase the implied volatility to make you pay up higher for those contracts in case there's an event coming that they don't know about. So it kind of helps them that, they're upcharging you for contracts as they have to hedge and, position around you. So one thing you'll see is IV go up. But what happened on this one, right? There was between this 9-second transaction, the spot price jumped $1, which, if you know about options, the stock going up should make calls go higher, right? But what happened to the contract price here? The contract price went down, right? It went from $8.30 a contract to $8 a contract, with the spot going up, and so what that's a red flag, right? That's a red flag where you immediately go, okay, this isn't making sense here, and it's not not what should be happening, right? So this is where I'm starting to say, okay, they're riding these because spot went up, contract went down, and then the last thing we look at, right? And I get a lot of people get too obsessed on the IV because it doesn't move every time. It's very dependent on the instrument you're trading. It's dependent on the time on the contract, right? It's harder to move IV on further dated contracts, in my opinion. So IV is like the final last clue to help you tell a story. It's not a requirement. So that's the biggest thing I could tell you when people get tripped up on that. But this is a big clue here on this. So IV dropped on an ask side call. So this doesn't add up. So this is where I'm inferring that they're writing these. And then as the end of the sequence goes, these contract prices continue to decrease, right? IV continues to decrease. And just like I mentioned, when people are rapidly buying calls and they increase IV and increase the contract price as they're rapidly buying them, like we see them in the Discord call outs, right? When we see flow come in on some like the IBM 300s this week is a good example. Contract price rips, IV rips because of the rapid buying. So this is your clue for selling or closing, or whatever it may be, to look for on this IV drop with the contract job. Typically what you want to see for unison buying, you want to see spot going up, contract going up, IV going up in a perfect world, but IV doesn't have to change. For selling, closing, writing, spot going down, contract going down, IV going down. So in this example, this is a tough one, right? Because it's all ask side lines. It looks like buying, but in all reality, the contract pricing and the IV are telling a different story for you here. So big nuance there. Probably one of the biggest ones to talk about. There was the same exact example on LRCX this morning, and same kind of story, right? Same trader right here, all transacting within 19 seconds. Well, in this case, spot price did go down, so you don't have that to go with it. But rapid call buying like this on weeklies, they bought over $1 million worth of weeklies here within 19 seconds. Contract price dropped almost 10% from 7 to 640 there, with spot only down $1. Same thing on the IV. Initially, IV goes up, but then slowly starts to go down on these sell orders all the way down into the 105s there. Contracts dropped over 10% there within 2 minutes. So again, ask side, but this is clearly a sell to open order, in my opinion, just based on this. And again, if you had bought calls here, you would have been very misled, not assuming, you held through MU tonight. So in my opinion, again, very clean read, but ask side is not, always as straightforward as it looks like. And actually, let me, just for the sake of looking at another flow service, just in case anybody else uses unusual whales, I'll bring it up and we can look at that. All right, so LRCX 626. All right, so even Unusual Whales showed it on the ask there, but then the second tranche was all below the bid after. So kind of a mixed read there. You would actually have to like take it down to like break it to each contract, which they do on that, but definitely a tougher one today on that. That was interesting to me. I thought that'd be a good example for today. So, all right, we have covered the coloring, right? This is an example with all of them. So again, the white, this line did not exceed open interest. This line exceeded the entire open interest, and then at that point, it switched to magenta, right? Because OI had been exceeded on the day, but any order still over the original OI showed up as yellow. So that's why you're getting the color mismatch here. So open interest was only 211. So open interest was 211. So any order over 211 is going to be yellow, but then after it's exceeded, any order under it is going to be purple. So that may be why I think some people get confused on the coloring there as well. So we know the coloring, we know obviously, the call, the spot price of the stock, call put, sweep and block. We covered that. We covered IV, implied volatility. We've covered the ask and bid. So next thing we'll talk about are spreads and how to identify them. So I don't think I have any great examples today on that. So essentially, to be able to read spreads and flow, you have to have some basic understanding of how spreads are structured, right? It's not it's not magic on the flow as far as like what the spread is or anything. It's just understanding basic structure of what a spread looks like. So let me finish my thought here and I'll go to that. So, again, take notes down or, Google it after the fact. But the two main things that I would work on learning and that you'll see the most in flow are debit spreads and credit spreads. So a debit spread, think of it as, when you buy an option, you're paying a debit to purchase it. So a debit spread, you are still like net purchasing something. So what that would mean is the easiest way I can think to explain it for a debit spread is you buy the nearest strike to the money, and then you sell the further out of the money strike. So for a call for LRCX, you would have bought a 380 call and then sold a 395, right? So on a debit, you're paying for the more expensive contract and you're selling the cheaper contract against it, which does a couple things. It lowers your cost basis in the net debit you're paying to be long that stock via options. So, you bought a contract for $5, you sell a contract for $2, you're really only paying $3. So you've limited your risk to be involved like with, upside potential in the stock, but you're capping your, upside potential, right? So if you bought a naked call, if you bought a single directional call, if the stock gets bought out and goes up 100 points overnight, your gains are unlimited. It's as high as it's going to open up at. If you if you buy a bull debit spread, you've capped your upside. So, you're got in a buyout stock, it's up $100 overnight, but you covered your upside, you capped your upside with that sold to open call. So although the stock's up 100, let's say you sold a call 50 points lower. So your upside is capped there. So, the main things of a debit spread, it lowers your cost and caps your risk. In my opinion, you see smarter money in spreads and flow. So just definitely something like familiarize yourself with. So for a debit spread, you're buying the closer to the money strike, you're selling the further out of the money. So for a credit spread, you're doing the opposite. So for a credit spread, you're no longer paying for the option. You're now getting paid to take on the trade and you're receiving a credit for it. So now you would sell the closer to the money option, you would sell the more expensive option, and then you would buy the further out of the money option to cap your risk. So when you sell a naked option, and this is why they won't usually let you sell naked calls or anything, you have unlimited risk, right? If you've never sold options before, you think an option can go worthless. Well, it can go minus 200, 500, minus 1,000% against you. There's unlimited risk, right? Imagine you sold calls on MU 3 months ago, right? You'd be beyond upside down mortgaging your house. So there's a lot more inherent risk on selling naked options, and I think why it gets like such a bad rap and why people caution you from it. But what a credit spread does is it allows you to cleanly define your risk and your reward. So again, you would sell the closer to the money option, you would buy the further out of the money option, and whatever the difference is the credit you receive. So again, to use the same example, this time you would sell a $5 option and you would buy a $2 option. So now you have a max profit of the difference, which would be $3, right? So you have a max profit of $3 and then your max risk. Well, I'm probably getting too far in the weeds on as far as that, but your max risk is the difference between the spread you sold and the credit you collected. So in our example, you're getting a $3 credit. If you sold a $10 wide spread, 10 minus 3, you would be risking 700 to make 300. And that's kind of how they work out, right? Because they have a higher probability of working. So it's going to look like I can only make $300. Yeah, but if you're selling credit correctly, your probabilities of actually, your win percentage is going to go up because options are designed to go to zero, right? They're designed to decay by theta in time. So, selling spreads can, be like a passive kind of income thing. And the credit spreads allow it to, define your risk and set it up front, the max you can lose. It's just like buying an option, right? You have your max profit that you can, your max loss that you can have. And then to try and find some examples here. So there's usually a lot of multi-leg on SPY. But then if you're out there, because I can't bring over screenshots from the unusual room, they're from yesterday. Oh wait, yes I can. I figured it out. All right. So again, let's go back to our ask and bid, right? So instead of a type being a sweep or a block, we now have a multi-leg because these options were transacted at the same time. So how do we know that? Timestamp. Again, timestamp is the first thing you check. Always check your timestamp. This tells you that this is, the same player. It's the same trade. Now, what did we talk about? It's the closer to the money strike was purchased and the further out of the money strike was sold. So this would be a, net debit. It's a bear debit spread, right? They're buying downside on SPY. They're buying the end of July 725 puts, and then they are selling the 695 puts against it. So what does this do? Instead of buying $8.2 million worth of puts, they're selling 3.8 million against it. So this reduces their, net debit to roughly, without me doing clean math here, about 4 million, right? A little bit over 4 million. So instead of spending 8 million now to hedge their portfolio, they're only spending 4 million, and they're like, worst case SPY goes down to like whatever, 700. They're not planning on the market to tank, right? They want to like hedge for as cheaply as possible. So this would be a good example of a bear debit spread, right? Again, buying the closer to the money strike, selling the further from the money to reduce the cost of it there. I have unusual whales up, but I'm still doing black box here. All right, now let me find a credit spread here. All right, and while I look for that, we'll talk about this here. All right, so this is a bit more complex, but it's part of a bull debit spread. So we will kind of talk about this, and I'll try and explain what's going on. So again, this is coming to another nuance of trading and reading options flow is kind of like a sense of familiarity with it, and like seeing this long enough, you'll be able to kind of piece stories together here. But again, let's reference our timestamp here. This is a 3-leg option, right? 11:08:20. All three transact at the same time. And there are there's actually an odd number of contracts here, so changes it up on you a little bit. But what they're doing here to help finance that bull debit spread that they are buying, they're also selling puts, right? So this is another credit that they would receive, which helps lower the cost of this bull debit spread that they are putting on. So sometimes when you see these get posted without context, again, reference the timestamp. This will let you be able to like group, the tray that you need to be looking at instead of looking at all this mess, group the timestamp and then try and come down and see what they could be doing. Again, this is another name that is going to have worse spreads. So you have to kind of give some leniency on the ask and bid on these. But the put sellers is kind of the clue here, in my opinion, on that. So a 3-leg spread there where it's structured to a bull spread. And then let me get a credit spread here. All right, so we talked about, again, debits. The more I talk about it, the more I'll drill into your head. Debits, you're buying the closer to the money strike, and you are selling the further from the money strike. On credit spreads, you are doing the opposite. So you are selling the closer to the money spread, and then you're buying the further from the money spread. So, and again, I'm using this for a example here. These guys are completely blown out if this was actually a credit, but this is the structure of them. So this will click the live button under voice. If somebody can help him out. But is it not showing you my snip tool? Oh man. Okay, sorry, I was snip tooling over and thought I had figured it out there. Okie dokie. Well, and then historical is going to ruin my timestamps. Okay. All right, can you see? Did Discord come over to the screen? or is it still black box? Okay. Well, that answers that. Okay, so bear with me. I gotta find some structured spreads here on this. It's not letting me. Not let me bring that over to share with y'all. Okay. All right, well, if y'all didn't see any of those examples in here, this is a... All right, so this is a good example on MSTR of a bear debit spread, right? Again, they are buying the closer to the money strike. They are selling the further from the money strike to lower their cost basis. So, instead of putting down $158,000 in puts, roughly, they're minimizing that to about, 60,000 roughly. So again, they have capped their potential for, upside reward, because once MSTR reaches 89, their profit will be maxed out, or, slightly exceeds it. Versus if they had just bought naked 94 puts, MSTR could drop to $50 tomorrow and they'd be millionaires. But since they put on this bear debit spread, they unfortunately would be capped at that 89 profit area. Then, and again, same thing here on Zebra. This would be a bear debit, right? They're buying the 240 close to the money, selling the 210 against it. Again, timestamp, sequence. And this is actually, I didn't even see the top line on that. So that would be a three-leg sequence like the, yes, three-leg sequence like that nice example I was talking about, y'all couldn't see. So again, same timestamp, 359.23. The closer to the money strike puts, the further from the money bought and sold. And then they are also selling calls against this position to help fund the bear spread, is how this would look. So bearish trade here. Let's try and find a credit real quick. Again, there's those MSTRs. So here's an example. Yeah, there's three legs to that. So I posted, okay, while I'm thinking of this off the top of my head, talking about rolling positions, again, this comes back to an open interest lesson, right? So how do we know a position is being rolled? Well, technically we don't until the open interest updates the next day, right? We can't 100% say they close this because the flow is white. Open interest is not exceeded. So while they're trading within that current open interest, it's really hard to get a specific direction. But again, look at your timestamp. This is all one sequence trade. Contracts don't match up, but I'll talk about that later. So you have one white leg attached to two yellow legs here. So to me, this is possibly a close. They're closing these July 350 calls. And what's interesting to me on this is typically, a lot of the times you'll see like a roll up and then out, so they buy more time. But in this instance, they are actually rolling up to the same expiration, but they're just rolling up their strikes and then turning it into a bull spread, right? So instead of a naked call being rolled up, they are locking in some profit and then putting on a little bit less exposure into a 380, right? Buy on the ask, the closer to the money strike, sell on the bid, the further from the money strike. So they just closed a trade for 7 million. I would have to go back through historical to see when that came through for the exact numbers of what they profited, but then they are rolling up and only exposing 3.5 million. So they're taking the 7 off and then putting back about half roughly of the, I'm not going to call it their profit, but from the original trade amount. So they're rolling up, reducing exposure. They still want bullish upside, but they're starting to cap it now. GE's made a big run, so they're starting to cap it around earnings, that 410 area. July 16th, their earnings. So that's another kind of important thing to take note on that. But great example here of a roll, potential roll, again, because you have to check open interest the next day to kind of make sure of that. So back to our quest for a credit spread. And you really don't see these as much in flow, which is why it's also a little bit harder to see. Typically, you're going to see, debit spreads mainly. Someone putting on, big credit spreads is putting on a lot of margin usually to show up in flow like this. Okay. Well, that's another roll. But for the whole point of this example, ignore the other two lines here. Just look at the yellow lines here. I don't care if this is the actual intention of the trade because there's other legs attached to it. The whole point of this is to show you the structure of what a credit spread looks like. So on Qualcomm here, this structure is a credit spread, right? They're selling at the bid the 205 calls, the closer to the money calls out of this, position, and they're buying the further out of the money. So now they are receiving $225,000 roughly in credit, to where if Qualcomm stayed under 205 by expiration, they would collect that entirety in premium. Obviously, these guys are mega screwed after hours, but again, this probably isn't exactly what's going on here. So again, to look at the credit, they received $1.60 per contract, and they sold a 7.5 wide leg here, right? 212.5 minus 205, 7.5. So that's your max risk is $750 minus the credit collected. So roughly $160 a contract. So 7.5 minus $1.06. So your max risk is $600 on that credit spread. So let's just kind of give you an example of what credit spreads look like. It's a lot more risk if you're looking at the reward. Like there's not like a asymmetric risk reward on like a naked option going up forever. It's more of a bet on the option decaying. So you'll typically see these, some further out of the money bets, right? They just want to collect the premium as it decays. They don't want to be, too right on any direction otherwise. So debit spread, credit spread. Let me go back and answer this question. Any rule of thumb about how sweeps get transacted? Is a single sweep line from a single broker, or can a sweep be multiple brokers added in exchange for an exchange sweep? Further in the weeds than I would go, but no, I don't know of any personal rules of thumb. The single sweep from a single broker is, typically like, so when we're looking at a grouped transaction like that, it's going to be the same person on the same broker, and they're sweeping, exchanges, not brokers, to get the orders filled. They're sweeping, if you go look at a level 2, the different exchanges that, are making orders to make the market. They're sweeping those to get the fill. So you just have multiple, market makers or exchanges, filling these orders. That would be about as far as I could go with it. Yeah, exactly. JR, it's credit spreads are great for, income generation. Charts went on a generational run, selling credit spreads. There when the market got less than favorable, he was selling, call credit spreads and did pretty well with them for a while there. So it's, selling puts as income generation, and then selling credit spreads as income generation. It's more so, having a higher probability of actually making money on the option expiring versus getting the direction right in a certain amount of time. So I think I've covered the majority of it. I don't want to get into, credit spreads, debit spreads. All you pretty much need to know as far as structuring any other trades. Really the only other thing to talk about are butterflies and IR condors. I simply will tell you, iron condors are very easy to explain. You're selling credit spreads on calls and puts at the same time. So you want the stock to stay within a certain range, but this way you make credit on the upside and the downside if it stays pinned at a certain level, right? So um, just for example, on the Qualcomm trade here, right? So they sold this 205, 212 half credit spread on the calls. Then they would turn around and sell like a 185 put and buy a 175 put or something to collect credit on the downside too. So they want Qualcomm to stay between 105 and 205, and they collect a max credit either way. So that's all an iron condor is, and then a butterfly is a little bit more difficult to explain. And rarely ever see them, so I don't think that's worth spending time on. So at that point, it's been about I'm close to an hour already. We'll open it up to any questions. Was anything confusing? Is there anything else you want me to talk about a little bit more in depth, or that I did a poor job explaining? I know I didn't do that good a job, guys. Wow, that's impressive. Okay. Okay, so let's see. Sorry, Rumor. I tried to bring up. I guess when I host my screen on Discord, it like doesn't let me bring anything else up over top of it or something. I don't know, kind of weird. But um, so quickly, Phantom Prince. Right, what Phantom Prince am I paying attention to? You're looking for something close to range, so you're looking for, I would say, anywhere from 2 to 5 points on like the Spire cues, and then you're looking for, and just to look at them. So Phantom Print 8, I mean volume 8. That's how many shares it was. So very insignificant. Spot when this transacted was 738.11 for SPY, and then the Phantom. Wait, yeah, the Phantom price came in at 686.98. So that's like $50 from here. Very far out of range. Small share size. Would ignore it. What you want to see are, and I don't think we've gotten any relevant ones today. Okay, so before the market closed, again, these volume spot 0. There's no, and it's still not. Yeah, there's not really any good examples today of something that I would be like, yeah, that's a good Phantom Print. Good Phantom Prints, quote unquote, are rare. Um, Especially now, seemings like it used to be. I remember sometimes there was like a spur a few years ago where like we'd get a Phantom Print like $1 or $2 like above range or something, and we would like run and hit it immediately. Those are when they're more useful, or on individual names. But the trick with Phantoms is it can take so long to go hit a Phantom Print. I can't remember which one it was on PLTR or something. I was tracking a PLTR Phantom last year for ages, and it took like 6 months or some shit for it to hit. So it's they're kind of hard to time, and it's very rare to get like the good Phantom Prints, in my opinion, where they're like more actionable in a shorter time frame. So hope that helps. But yeah, that's why I don't like alert them in the dark pool room very often. Charts keeps track of all of them that occur, and I know some people that have a chart specifically for Phantoms, and watching them get hit, they still can act as like support and resistance lines, but um, better for engagement bait most days than anything actionable. Well, I guess I should have done a dark pool class. What do I look for in dark pools? So dark pools, you are looking at the percent of average daily volume. And I gotta say, since I have the volume leaders subscription now, I gotta say that shit is awesome. Because if you're into dark pool prints and like tracking like large institutional positioning, having a chart like already graphed on it is great. But um, so typically you're looking at percent of average daily volume to know if you have unusual prints. But then also, and this is why it's like not sexy to talk about, but for dark pool, what um, you're looking for accumulation in ranges, and you're looking for distribution in ranges, right? You want to see a uh, a footprint, so to speak, of someone accumulating shares in an area. Um, I don't have any examples handy, but outside of like large prints, like this is on the market summary. But NVS was on there because it had a 50% average daily volume print in one print. And then, I think it was like almost, I can't remember the number. It was like 100, almost 100% of average daily volume for NVS. So this, in my opinion, would be notable. Like this would be an area cluster to put on your chart between that 150, 254. That would probably be the level I chose to put on there because it's the large single print. But so that's what I'm looking at for dark pools. Like simply, if you're looking for a large print, you're looking for percent of average daily volume. On the SPY and Qs, you were looking. I don't look at anything under 1 million shares, right? I don't care about anything else unless I find out after the fact that it like accumulated to something bigger on say they hit the same price like 50 times that day and it ended up being 3 billion or something. But SPY and Qs, only 3% doesn't seem like much, but this 1.5 million shares, over $1 billion in one print. These are, and this was the largest on record for QQQ. But that's what you're looking at for SPY and Qs. If there's only one specific advice that you could give when it comes to reading options flow, what would it be? Don't be lazy and click the graphs that Unusual Whale has that say whether it was bought or sold. Go pull up the individual lines, learn how to read like through the timestamps, the ask and bid and the contract price. Like you want to see that sequence, learn how to do that because you'll get further with flow. In my opinion, I still see a lot of bad reads online with that. And then the next one was executing on options flow. Build a story. Don't just look at the options flow and follow it blindly because nobody is sizing. Unfortunately, nobody knows how the flow is sized according to their own portfolio, and then you're gonna follow it with more money than you should, and then you're emotionally gonna sell it. So build a story for yourself, like have some conviction based on the chart, and make it your own trade. If you're gonna blindly follow flow, my best advice would be size for zero, and don't sell it unless it you know size for zero. That's the best thing I could say. Can you talk about what those options flow that come in on volume alerts with the exact timestamp? Do you mean when it alerts on the chart over here, or like the volume active alerts in the alert stream? Yeah, you're welcome. Thanks for hanging out. Appreciate it. Do you mean trying to? I don't even know which one would have had it happen today. DVN maybe. No. I'm just confused on what you're asking. If you're asking about Oh, do you mean when shares are tied to dark pool, like when you get a big block order tied to the dark pool? Okay. Yeah, so that's where waters get muddied a little bit, and why I don't get super opinionated on when I see that happen. Because yes, we can know the intent of like the options as they come through, but we don't know what they're doing with the shares. Um, so yes, they're usually tied to shares. I don't have any examples off the top of my head to show you, but essentially a few things can be going on, right? So I don't know if you remember the Intel trade from a couple weeks ago. There was like a 5 million share dark pool block, and then like a $25 million call option. To me, in my opinion, that looked like they were possibly, closing shares and then rolling to in the money options exposure. That could be an option. Um, they could be a hedge to the shares, right? They could be, you could see a put block come in to the shares, which, they're buying the shares, but they want the protection as they put that on. They're not too sure that it's going to work immediately, so they buy some protection on top of it. You can see collars to where that's, they're double protecting their position. They're selling calls upside, they're capping upside, and then they're protecting their downside buying puts. So essentially, there's a few different things they can do with it off the top of my head, but the trick is you don't know like the true intent behind everything. You can take it at face value, and I can typically tell you what the face value is, but I'll also always like precaution say I can't tell you exactly on the dark pool. Alert filters, there you go. Pretty much leave them all on except the 52-week high and low stuff. Actually, I used to have that on. I probably should get that back. Just keep them all on. It's just like when that happens, it gets kind of annoying. So I think that's why I turned them off. Oh no, no, you're good. Yeah, of course. Thanks for showing up, man. I appreciate it. So if I see flow, so my day's kind of different because my thought process when I'm like running voice and Discord and stuff is like immediately get you guys the information, provide you with that, and then like my process kind of back burners for a second, so I may not end up doing like a full look through until yeah, Quincy, thanks for hanging out until later on. But so typically I see options flow. I would say 90% of the time I know what it is. Like sometimes I have to look up stuff, but first thing I do is I check the name, you know, is there a theme for it, and then like what is that theme basket doing? Um, and then I go to a chart of it in itself, and I'm usually looking at a weekly or a daily chart. Look around if there's like any similar names. How are they doing? Has there been any other flow in those names? And then is there a spot I'd rather buy this flow at? What is there any thesis to this name? Is it a strong sector? Is it above its moving averages? Is it below? Is it red on the month? I talk about market structure a lot. Is it under last month's low? Just like simple shit like that I'm like looking at and thinking, and a thing I didn't talk about earlier that I should have mentioned is like, options flow is different for every name, right? So, Microsoft Flow, I rarely ever post Microsoft Flow because, it and a big order on Microsoft is like 5 million at a minimum, right? But, some random ass name like NUVL, which I've never heard of, like you're not going to see a $5 million order, right? Like even 83,000 on this could be interesting, right? So it just kind of depends on the name that you're looking for, if it's interesting or not. Like the Boeing flow today was like I thought a 30 grand order or something was interesting, right? So, or okay, maybe they're a little bit more, but you get my point. It's all relevant to the name. as part of one of the clues you're putting together, but hopefully that kind of gives a gist. But essentially, you just want to know what kind of name it is. It is like shit, like the nail this morning, like when the nail flow came in, like I knew that was 2 times leveraged home builders. Um, I'd already been watching Home Depot, like stuff like trying to put like a picture together with the flow, I guess. Uh, I think I would refer back to my other point is that um, you don't you don't know what the options flow is willing to risk. You don't know who you're following, um, and you have unless you can build your own conviction. It's hard to just buy something and sit through a 50% drawdown. When maybe the person who bought it is like knows 110% that that stock's going higher before the expiration, right? So the biggest thing with flow would be to build a story, but if you're just going to blindly follow options flow, I would size for like near zero or be willing to sell when the options flow sells, like when the flow you followed is like gets out of open interest or something like that. I think those would be like some of my best advice. All right, we're a little bit over an hour here, so again, appreciate everybody who hung out the entire time and asked questions. I hope you learned something. Hope it was helpful. Thanks for hanging out with me. But again, I will see y'all tomorrow. Have a great evening. Again, thank you very much.